the best way to develop a insurance strategy or the best way to develop a risk mitigation strategy is to be able to understand and quantify the risk that you're insuring. And what I mean by that is if you don't have a wealth creation plan and you don't have something that you're moving and aiming towards, well then understanding how to protect that is incredibly difficult. And what you inevitably end up doing in most cases is over-insuring because you can't actually quantify what the risk is.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. Oh, that felt a little bit weird. I felt like I was saying Andrew Bills. Sorry. I digress. Here we are.
Back again for another episode.
360 Money Matters podcast. We have gotten off to a horrible start, but we're going to get it back on track.
Week in, week out. Let me just check that the microphones are on. We're good to go. Okay, let's rip into it because we've totally botched that up. Andrew, what are we talking to everybody about today?
So today we are talking about some personal insurance cover. So we're talking about the benefits of whether you hold it inside super, outside super, and some of the benefits of each method of owning life, TPD, or income protection insurance cover.
Some of the benefits and also some of the
cons associated. We're going to look at how one strategy might be better versus another strategy, and talk about how you can structure your personal insurances.
Yeah, and I think that's probably something that we're seeing more and more of. I guess with people, as life becomes more complex, you take on more responsibilities with, family, kids getting older, or having children, taking on debt, increasing in interest rates, increasing cost of living. Financially, there's a little bit more going on. The government's levying, land tax. We spoke about that in last week's episode. A few weeks ago, we spoke about the government ripping us with the stage 3 tax cut changes that they're broken their election promise on. So everything is getting a little bit more complicated. So having the right insurance in place is definitely something that we're having deeper conversations about. And I guess one of the main things, without wanting to give too much away, but how do you fund that, and what's some of the opportunities, the pros and the cons that we see with owning it inside versus outside superannuation? So Andrew, what's the first big thing that we look at when we're talking to people about how they should own their insurance policies?
Look, I think the first, and it's kind of just the easiest one to get off the bat, is generally, and we're not going to run into the specifics of it, but there's generally 4 types of personal insurance covers that you can have. Life insurance, touch wood, you pass away, an amount gets paid out to whomever you decide. Permanent disability, which is if you can never work again in your occupation or in any occupation, it's a lump sum payout to you. Income protection, whereby if you can't work for a period of time, now you set whatever that period of time is, you'll receive a monthly benefit until your benefit period ends, which can be 5 years, age 65, sort of anything in between. You structure that benefit. And then the last one, which is trauma insurance, which covers a certain, or you need to meet a condition in order to receive a trauma insurance benefit. Depending on the policies, there's 60 odd different conditions. Vast majority is cancer, heart attack, or stroke. But that's the easiest one to kind of get off the bat because trauma insurance cannot be held inside a super. So it has to be held outside of superannuation. And so you kind of lock that one away and say, okay, benefits, cons, whatever you want, you don't have an option.
Take that one off the table.
Yeah, exactly right. And so what's ultimately left is life insurance, permanent disability, and income protection. And really what we look at is, okay, you don't necessarily need to hold all of them inside, all of them outside. You can do a blended arrangement. And so, okay, let's first go into, what are some of the benefits of holding a policy inside super?
The benefits of holding it inside super, and I'll talk about how we tend to think about it from an advice perspective as well too, but the cost of premiums is probably the biggest hurdle and consideration that we need to give thought to when we're recommending which way to go.
Yeah.
So if you're funding insurance premiums out of pocket versus inside superannuation, all of a sudden you need to find that extra, whatever it may be, the insurance premium amount that you need to find each and every year or each and every month, depending on how you've got it set up. So how are you going to fund that?
Yeah.
Versus inside superannuation, you're using your superannuation. It's still your money, but it's within the superannuation environment, so you can't touch it until you meet a condition of release. But that right off the bat is the first hurdle that we need to reconcile and work through is how do you fund these things? Because getting the trade-off and the toss-up between having the right level of cover, the right types of cover, the right level of cover, and then having the cash flow in order to be able to fund it. And if you don't have the cash flow, does that mean that you look at a different ownership structure like what we're talking about? Or do you start mucking around with the benefit amounts? Or do you consider, which we never really like to do, is eliminating cover altogether?
Yeah.
So there's some of the things that I guess we tend to think about when it comes to that first hurdle around, what's the benefit having it inside super versus having it outside super. And then to add a little bit more complexity just around the cash flow piece is there a better use for the money? So, you may spend, I'll give you an example, you may spend $2,000 a year on insurance premiums and pay those out of pocket. But you may then decide as an individual or as a household that you'd prefer to use that $2,000 to make an accelerated debt repayment on your mortgage.
Yep.
So cash flow is the big one that we talk about in terms of the impact that it has on your cash flow inside superannuation versus outside.
Yeah. And look, I think for most people, that's one of the biggest considerations when they're looking at, inside versus outside super. You're looking at, do I have the capacity or want to pay for it outside of superannuation? And that's one of the sort of main drivers to whether you go inside or outside. While we're on the topic of, the cash flow implications, what some people choose to do, and is another sort of crafty option, is you can fund insurance premiums inside of superannuation and then just make contributions into your super fund in order to cover the cost of the insurance cover. Now, what that does is it creates a layer of flexibility. Yes, at day one, it may not necessarily, provided that you equalise it in terms of the tax deductibility of contributions and all of that stuff. But if you've got, for simplistic sake, $2,000 in insurance premiums, it's funded inside of superannuation, and you also put $2,000 in contributions towards your super fund in order to be able to cover the cost. What you then do is create some flexibility in that, okay, if next year I don't have the $2,000 cash flow or I choose to allocate it somewhere else, I don't necessarily need to, pay the money into the superannuation. Or if I want to pay more, or if I want to pay half, or if I want to pay less, you have the flexibility to decide. Whereas if a policy is held outside of superannuation, when the policy is due, you need to pay the policy. You can't pull money out from superannuation in order to pay for it. So there's a little bit of flexibility in holding cover inside of superannuation.
Yep. So you can match your, your cash flow, if the timing of the premiums match, and basically you want to essentially stop your super fund from maybe absorbing all of those costs, but you do it based on your circumstances and your cash flow at that particular point in time.
Yeah, exactly right.
Andrew, what about the tax efficiency of it? I mean, obviously, if you're paying for premiums outside of superannuation, you're using after-tax dollars, right? So there is no taxation benefit associated with that. You get your income, you pay your tax through your employer, PAYG, so pay as you go. You're left with after-tax dollars, you pay your premium, away you go. Income protection is probably slightly different, so we'll just carve that one out. But the difference between that versus being able to fund it inside super?
Yeah, so quite simply, life insurance permanent disability is tax deductible to the fund.
Yep.
So the fund will automatically claim a tax deduction on your life insurance and permanent, or should automatically claim, provided that it's structured correctly, a tax deduction on your life insurance and permanent disability premiums. And so as a result, for most people, when you're talking about superannuation, you're talking about a 15% tax environment. So you're effectively getting a 15% discount by funding those through superannuation versus outside of superannuation.
Yep. Income protection, if we fund it out of pocket, we can claim it as a tax deduction.
Yep.
So during your tax return, you'll give your accountant the details of what you paid in terms of your premium for that particular financial year, and they will claim that as an expense in your tax return.
Yep. So that almost works as a disadvantage of holding income protection inside of super because, I mean, assuming that you're generating an income and so you've got income protection, you're usually paying more in income tax, or your income tax rate is higher or significantly higher than your superannuation tax rate. So the deduction is bigger if you're paying for it outside of pocket versus inside of superannuation.
Yeah. Yep. And the reason why that's available as a tax deduction is simply because that benefit, if it was ever realised in the form of an insurance payment, that benefit there is treated like gross income, so you will pay tax the same way that you do with your work or any other form of income that you've got. You pay tax on that. So if it's for income producing purposes, which is what the insurance premium is for, then it's available to be claimed as a tax deduction.
Yeah, absolutely. And Billy, default covers, how does that play into it?
Yeah, so look, one of the things with some superannuation funds, you can go through kind of like an automatic insurance application process where you will get default levels of insurance cover. Usually that's based on how old you are when you join the fund. You go through that without needing to apply for medical underwriting. So in some instances, it could be of benefit to people if there's, existing medical conditions or they're worried about the medical underwriting process. You can go do that. It's a lot simpler. It's not tailored to your need because it's off the rack based on your age, but that's definitely one option that you can get with cover through superannuation. So that could be a benefit alongside some of the funding mechanisms that we were talking about before.
Yeah. So you're someone that maybe, for health reasons or family history or whatever it is, you're precluded from really being able to apply and get any income protection or life insurance or anything like that outside of superannuation. So you've already got that as a default benefit. So you want to keep that obviously in the superannuation environment.
Correct. Yep. Andrew, some of the disadvantages of holding cover within super?
Yeah. I mean, look, one of the biggest ones which a lot of people can forget about is life insurance and permanent disability, depending on who receives the money, so depending on your beneficiary circumstances, there may be tax that's paid on it. Yeah. And so one of the considerations is, okay, do you then gross up the benefit amount in order to be able to cover the additional tax that's paid on paying any of those proceeds out? So that's definitely a disadvantage of holding cover inside of superannuation, because if you held it outside of superannuation, there'd be no tax that would ultimately be paid.
Yeah, and that can't be understated simply because, for a real simplistic beneficiary, say a spouse, there is no tax on an insurance payout. In the event that it goes to, say, an adult child, you could be paying significant amounts of tax on that. So assuming that, you'd be in that position, it could substantially change the way that beneficiary, the benefit of the beneficiary, there's a bit of a tongue twister there, the benefit of the beneficiary can change quite significantly because of the amount of tax that needs to get paid. So yeah, grossing it up or having at least received advice or giving thought to who's going to get the money eventually is, and how is it going to be taxed, and then do I need to adjust accordingly to compensate for that?
Yeah, absolutely. And I mean, Bill's obviously it's going to impact the growth of your super, right?
Yeah, so I mean, it's an expense. If you're housing insurance premiums inside superannuation, it's an expense to your superannuation fund. It's going to have an impact on your superannuation fund simply because it needs to meet the premiums each and every year or each and every month, depending on how you've got it set up. One of the challenging things that we're finding with insurance, and it's just the way that it goes, obviously we get older each and every year.
Except for Billy, he's locked at 39.
Unless you're me, you just stay at 39 and we're done. So if the insurers are out there, then just make sure my premiums are nice and steady. But we get older each and every year. And as a consequence of that, the risk of something happening to us increases. Therefore, the insurance companies, obviously they know this, they increase the cost of our premiums each and every year. So it is something that's going to be getting more expensive and having a greater impact on your superannuation fund each and every year. So keeping an eye on that, especially as you start to age and get a little bit older, where the premiums do become more expensive, it can be quite onerous for the superannuation fund.
Yeah.
So that's one of the disadvantages, that it does come out of your super fund, albeit not disregarding or discounting what you were saying before, Andrew, offsetting that with some contributions and things, but it's definitely a disadvantage. And that comes back to that trade-off that I was describing before between funding it out of pocket out of your own cash flow and then doing it out of the superannuation fund. But the drawback and the trade-off between the two is, do you lose it out of pocket or do you lose it out of your super fund? And it could be at different points in time you have a different appetite.
Yeah.
Which is, interestingly enough, maybe when you're young, you can't afford the out-of-pocket expense. So you'd prefer your superannuation fund to pay it. But then as you get older, you've got more surplus cash. You want to be able to pay it out of pocket because you're trying to preserve your superannuation balance as best as you can. So there's no right or wrong. It's all based on individual circumstances. But yeah, that's one of the disadvantages of holding it with inside superannuation.
Yeah, absolutely. And the other thing to really consider is there are some differences in the definitions on each policy when you're holding it inside versus outside of superannuation. Not going to delve into the specifics and details of that because it changes with each product provider and it changes on, depending on what type of product that you're looking at. But one of the things to really be careful with is, okay, what are the policy definitions when it's held inside of superannuation, which is generally a more restrictive environment versus when you're holding a policy outside of superannuation. And so even though it may be impacting your cash flow to a greater degree, maybe you say, okay, well, I want to have, the platinum benefit, so to speak, or I really want to have something that's of great quality. And so considering the fact that the definitions generally aren't quite as strong when you're holding it inside of superannuation, or they are more restrictive, is a consideration when you're looking at insurance policies as well.
Yeah, and I think that's a good way to tie a nice bow around it, Andrew, in terms of the things that we need to consider. I've been talking about trade-offs and things like that, but how does your, insurance strategy and how you fund it and the benefits and the disadvantages in terms of the different ownerships options available, how does it fit into your broader financial strategy and your overall financial circumstances and your overall strategic plan? Because it's not one size fits all. It's different for everybody. People have different objectives. People have different circumstances.
Look, not to say that it can't be done, because it certainly can be, but the best way to develop a insurance strategy, or the best way to develop a risk mitigation strategy, is to be able to understand and quantify the risk that you're insuring. And what I mean by that is, if you don't have a wealth creation plan and you don't have something that you're moving and aiming towards, well then understanding how to protect that is incredibly difficult. And what you inevitably end up doing in most cases is over-insuring because you can't actually quantify what the risk is. So getting a solid wealth creation plan, so you know where you're heading, what you're aiming towards and what you need to do to get there, makes it a lot more easy to develop a risk mitigation strategy in order to make sure that if, I was going to say, but I don't know if you can swear on a podcast, if something was to hit the fan, then okay, I know that I've got something in place that's going to cover me for, still meeting that wealth creation strategy.
So essentially what Andrew said there for the last 2 minutes in a sentence is get advice.
Basically.
Because there are a lot of intricacies associated with it, and the chances and the probability of getting it wrong in using an example like being overinsured or being underinsured or not funding it correctly or structuring it correctly, the probability of getting it wrong is probably quite high. And we see that all the time. Probably when people do find out, they're almost devastated, but you think you're covered for X, Y, or Z, whatever it may be, and your circumstances dictate. We go through the insurance needs analysis process so we can determine how much cover someone needs and say, okay, did you realise that in the event that something happens, this is how much you need up here? Not that the listeners can see this, but my hand's high in the air versus the amount of cover that you've got, my hand's down lower. There's a gap that you're exposed to, and when people see that, they just don't realise. So definitely, getting advice is well and truly recommended.
Yeah, because there are crafty ways to do it. I mean, we've already sort of touched on it, but whether you, salary sacrifice to partially or fully cover the premiums, whether you look at, having certain policies which the product itself allows partially funded inside super, partially funded outside super, and it gives the policy definitions of outside super. I mean, there are a million different considerations when you're looking at an insurance policy. And so when we're looking at a risk mitigation strategy, you're usually factoring all of that in, you're balancing all of the trade-offs off and recommending to the client just what you think is the most appropriate solution for their needs in essence.
Yep. Probably one of the last things to consider as well too, Andrew, is the inactive superannuation fund, and then what happens to your insurance. So you want to just run us through that and what that looks like?
Yeah, well, we haven't ripped on the government today, so why not do it for?
Well, in the previous podcast, I've been doing it, so I thought I'd lay that one up so you can do it. But if you want,
the bad guy.
If you want me to do it, I'll do it.
No.
The fact that we live in Australia and we can actually say that is great, because if we're overseas in another country and see you later, Billy disappears or something like that, I'll rock up 2 years later and I'll look 36.
Exactly right. No, look, I can understand to some degree why this came in, but the impact that it has when it goes wrong is just so much larger than the impact that it has in if it goes wrong in the opposite way. And what I'm talking about here is if your superannuation fund is inactive for 16 months, then the superannuation fund will cancel your insurance cover. Now, sounds all good and well because it prevents people from paying for premiums when they don't have a fund that's been contributed to and isn't active. But the impact that it's or the unintended consequences that it also has on people, that most people that we speak to don't even know how much they have in superannuation or which fund it's with, let alone the insurance cover that's funded through it. Mm-hmm. And so it is so easy to slip through the cracks. An email's gone astray or a letter's gone astray and someone's lost $500,000 worth of life insurance because they haven't contributed to their super fund for 16 months. And when a claim has come and they've needed to claim on the policy, it hasn't been there. So I think it's absolutely insane that it will automatically cancel the cover or that it's an opt-in basis and you need to continue to do that every 16 months because it leaves people wanting when they really need the insurance cover. And so I mean, obviously I've gone off on a tangent as to, what I think about the impact that this has had to people on insurance. But the public service announcement that we're trying to put out here is if you've got insurance that's funded through superannuation, you need to be on top of it. And you need to be on top of it in perpetuity because something as simple as, not having contributions for 16 months can mean that your policy is completely lapsed and fall to the wayside. And when you thought that you were protected and you're not when you need the funds, the impact is massive. I mean, most insurance policies, when you're talking about life insurance, when you're talking about permanent disability, you're talking about hundreds of thousands of dollars. This isn't, a little bit of money on the side. It has a huge impact to people. And if you're left wanting, the implications are massive.
So let's do a calculation. I'm going to run a hypothetical scenario, right? And I'll tell you what I mean. What do you reckon a $500,000 life insurance policy will cost a 30-year-old female for 16 months?
You should have been prepared for this.
Right? No. So while you're thinking about that, I'm going to run a scenario. So you and your partner have a child. She takes time out of the workforce on maternity leave for 2 years, does not contribute to superannuation.
Yep.
The superannuation rules that we're talking about turns the insurance policy off or cancels the insurance policy after 16 months. You've got a $500,000 policy in there, 16 months worth of premiums. All of a sudden, the mother of the child, your spouse in this hypothetical, passes away. You think you've got $500,000 and all of a sudden you go to make a claim and it doesn't exist anymore. How much do you reckon those premiums would cost?
For a non-smoker and someone that's not in a manual occupation, you're talking about hundreds of dollars, not thousands.
$500?
Maybe, yeah.
I thought $500, $600.
Yeah.
That is absolutely ludicrous.
Yeah.
Because in that scenario,
you're trying to protect
stuff up
a few $100, and what the person's missed out on is hundreds of thousands of dollars.
in this hypothetical. It makes no sense whatsoever.
Yeah.
And I guess that, that's a hypothetical, and we've kind of painted that picture in order to paint the severity of getting this wrong can be. But, talking about ripping into the politicians and stuff like that, it's, I don't know, policy on the run, not well thought out. Who knows?
Yeah, exactly. But I think that the real key to all of this is get advice, make sure that your plan is structured for you. And look, in that instance, if you had an advisor there that was looking over it, then they should be getting in touch to say, hey, this is what's happening with your policy. Do you actually want it to lapse, or do you want to, elect to retain it?
Yep. No, 100%. Andrew, well said, well summarised. Thank you for today's podcast.
Thanks, Bills. Thanks to all of our listeners and our viewers for jumping onto another podcast. And we look forward to catch you on the next one. If you got some value out of that one, please like, subscribe, and we'll see you in a week.
Thanks. Thanks for listening today. If you have any questions on what we talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.